Hi, everyone. My name is Phil Blancato. I'm CEO and President, Latimer Thalman Asset Management, Chief Market Strategist for Osaic. Welcome to another weekly Market Impact, our weekly podcast about all things going on, personal and finance, a little bit of both. Here we are already in mid-April. So, in New Jersey, we've had a pretty rough winter. It's been one of those winters that, reminded me of when I was a kid. It was a legitimate cold winter, and it didn't want to go away. So over the weekend, it's a long story. I think I mentioned this the other podcast. I plant about 115 tomato plants every year. So it's time of the year to really do a lot. And it's full tilt right now, turning the ground over. And this year I've got to put some new nutrients in my soil. In New Jersey, last year I had good fruit from the tomatoes, but by mid-season, by mid-August, they started to die from the ground up. And that's usually mold or lack of nutrients. So I got a lot of work to do. So if anywhere in the New Jersey area want to help me turn over the garden, add in all kinds of different nutrients to get my soil back to where it needs to be, let me know. This is where I did my dad. God rest his soul. This is where he was brilliant at it. He always had some tricky way to make it work and easy. Although I am excited that I have I think I've mentioned this before too. Some of the tomatoes go all the way back to Sicily from my dad bringing them over. So I've got some incredible San Marzanos from last year that were really very big. So I'm excited about those. Are all coming up. I've got 40 of those that are growing really well. And then about 30 Roma plums, but these I bought. So we'll see. I want a new variety of Roma plum that should be a little meatier. Last year the sauce was a little thin. So I have to, I'm going to try and compensate a little bit for it this year. The weekend was fun for me. I got a chance to drive my old car. I think I've mentioned this before. I have an old 69 Pontiac Firebird that I had to get going. It's been I have it, keep it in the garage, and I keep a trickle charge around, and I try to start it once or twice during the winter. But I got it out, got put fresh gas, put in, got the air going, filled the tires, and got it running, and the thing ran like a clock. It probably needs a little bit of a loving care. I got a couple of little things I got to do to it, but it's always fun to put the top down. It was 60 here on Saturday, which 60 for us is pretty good. We haven't had that kind of weather. Really a day here and a day there, but not very much. Now this week, we're going to be in the 70s, maybe even the 80s, which is kind of goofy. So it should be a fun week warming up. And as you know, the girls down in Georgia, got my blanket behind me today, are cruising right along. Luca and Marcella had a big weekend. Their sorority formal this weekend. I probably should put up a picture. They both looked amazing. And if I get a chance towards the end, I'll share a picture. But they both looked amazing, and kind of fun that they had this big concert they went to in celebratory because Luca is wrapping it up. She's down to 3 weeks left in her college career. Oh my gosh, she's beside herself. There's lots of tears flowing already. She's not sure, she's getting ready to graduate. It's a scary idea. So it's all good. It's all fun, very exciting that she is on her way to the next stop. She's going to go to Europe for a little vacation with one of her girlfriends, and then she begins work on July 8th. And I was having fun thinking about what am I going to charge her for? Well, we'll see. At a minimum, I'm going to make her pay for her own damn food. all these app deliveries. I'll see how much she pays for when she gets home. That would be nice to not have to worry about her expense anymore because Dad takes care of that too. Anyway, I hope you had a wonderful weekend. A quick market update here. I have a very special guest today. I want to get right to that. Dan Alamariu is going to join me in just a second. And I'm really excited to have Dan on, but I'll explain who Dan is in just a second. Well, it's funny for all the headlines. Now, if I said to you on January 1st, let's sit down and I'll make a deal with you. We're going to have a full-on war with Iran. Israel will be a part of it. And the rest of the world won't partake. It'll be probably from a geopolitical standpoint, most of the world's angry with us for doing it, even though there's a bigger, better benefit to Iran not having a nuclear weapon. But it's fine in the middle of a war that no one seems to want. In the country, most of the people don't seem to want it. Gas prices would go above $4 a gallon. There'd be concerns again about inflation. The latest inflation print would be 3.3%. Last week, we had a CPI report that said inflation has cracked back above 3% headline inflation because of the price of gas. Core inflation is still running around 2.8, which is a solid number. But the headline number, which includes energy above 3.3, mix all those things together. And if I told you the stock market would be flat, I would bet all of you on this podcast would bet and take that bet all day long. And guess what the S&P 500 is year to date? Flat, 0.07. The equally weighted S&P 500 up almost 3%. So oddly enough, for all the headlines, when we talk a lot about staying out of the headline, this is proof, for all the negative worry about what's happened out there. And I guess you could argue there's still more to come. And, there's definitely more concerns about this war and that it's not ending anytime soon and so on. Well, the stock market uses a pretty good predictor of what to expect in the next 6 months is flat. The Dow up 0.15 on the year, and even the Russell 2000 small cap stocks are up a whopping 6.5%. Growth stocks still down. You look at the Nasdaq on the year, only down 1.29, but large cap growth Mag 7 still down around 8% on the year, and large growth down on itself 5.5. But value stocks, companies you use every day to get around, think of car companies and banks. This week, we're going to get a gigantic reports on banks. We had so Goldman Sachs this morning printed a report that was excellent. Their profits were quite high. Maybe they're a little concerned about the macro environment going forward, but for now, they're doing great. So the value stocks up almost 6% on the year. The winner clearly, now let's go think about the lunacy here. What countries are most impacted by the heightened cost of oil, or more importantly, where they get oil from? Well, a lot of it's the Asian Pacific Rim. I'm sure Dan will touch on this in a minute. But oddly enough, where are emerging market stocks on the year? Up almost 11%. Where are international stocks on there who get a lot of oil from the Middle East? Up 6%. So you can't correlate headlines to what's happening in markets. It just doesn't work that way. And you gotta keep it to the facts. And there's one other thing that I think we're forgetting right now. When you look at the gas price drag, the top 20% of Americans who drive the most, they use about 1,000 gallons of gasoline a year, will cost them about $400 more a year based on this increase in price. The bottom 20% of Americans who use about only half of that, if not less, will cost them about an extra $150. But on average, every single person from the lowest income bracket, with those who make on the bottom 20 percentile, up to the top 20 percentile, are going to get a tax refund this year. The top 20% close to $1,000, all the way down to the bottom close to $200. So the net effect is that with the benefit of the bill, the one big beautiful bill, most people are going to not be hurt very much from a net standpoint on the price of gasoline. Now, you're not going to get this wonderful stimulus we thought we were going to get from the overall bill, but at the same token, gas so far has not overly hurt the U.S. consumer, and it probably won't hurt this year. What does it mean, though? Sentiment. When we look at what people think about it, sentiment hit an all-time low last week. We saw consumer spending rise month over month, 0.5%. So spending on one hand is still strong, but sentiment not great. So that's very unusual. Again, headlines versus reality. And then the big one for me, ISM services, the one that 70% of the U.S. economy came out last week, and that was up by 54%. Well, and that's a contraction from 56, but 54 on a scale of 40 to 60 is an expansion, still a solid number. So put it all together, for all the headlines, for all the worry, for all the stuff that we've talked endlessly about with the war, and at the end of the day, it comes down to earnings, economic growth, and the health of the U.S. consumer. We're still gainfully employed. The labor market's fine. It's not great. It's not bad. We're seeing some minor inflation because of energy, but not a lot. But on the other hand, there's counterbalances to it. And things are good enough. But it all does depend on where do we go from here. So for that, I have a very special guest today. Dan Alamariu is the chief geopolitical strategist for Alpin Macro. I often get the question, where do I get all my wonderful research from? Alpin Macro is a partner to us and a firm we use to use not all types of research, but everything from macro environments to micro environments. But today, very excited to have Dan on, who is a geopolitical analyst specializing in this. We got to know each other recently, and he knows all things war. So Dan, welcome, buddy. How are you doing? How was your weekend, Dan? What did you do? Anything fun?
Thank you. Thank you so much for having me. Good. I had a good weekend. I'm in Florida, so it's quite balmy here compared to
Oh,
Jersey. So
Florida.
yeah, it's
I,
but
I read a piece about how there's an effort to clean up the mangroves in Miami. That there's too much junk in the mangroves. And there's people literally running around trying to good for them. We need that in New Jersey. One of the things that's terrible about New Jersey, we have so much litter, and especially this time of year because they don't clean it in the winter. And then finally spring comes and some of the crews get out there, but there's so much trash on the side of the road. It drives me crazy. So at least in Miami, they're cleaning it up. So Dan, maybe a little bit about yourself, and then we'll jump right into questions. A little bit about your background and your history, and how you know so much about geopolitics.
sure. Thank you again for having me. So I'm the chief geopolitical strategist for Alpin Macro. I've spent maybe about 20 years, give or take, looking at how basically geopolitics and politics in general impact market and economic outcomes. Prior to this, I was for about almost 9 years at UBS in a similar capacity, and before that, I've spent about 7 years at Eurasia Group. And prior to that, I had sort of a traditional career in finance. Uh, Academically, I've always been interested in war and economics, and sort of that's my academic training as well. So what always has interested me is not only what happens next, which is of course the most challenging part, but the question also for investors, the thing that you referred to is the so what? Is this going to move markets? Is it going to move economic outcomes? And what can investors do around that? Whether to capture some sort of alpha or some sort of profit, or whether to get out of the way when obviously when something is indeed risky.
For sure. And you have a scenario for everybody who's listening to this podcast. We got lots of folks listening. We're all kind of confused. I mean, we hear these headlines every single day. So, what's the latest? Obviously, blocking the Strait of Hormuz. I don't even know what that means. I was trying to read about it this weekend. I don't know what they're going to block. And then Iran counter this morning. What's the latest in your opinion?
It's a good question because every day is something new, right? And it's been like this since the beginning of the year. It's been sort of a very busy geopolitical year. Venezuela, the Trump kerfuffle over Greenland, and now this, of course, which is much bigger issue. So what happened over the weekend? There were the in-person talks between the U.S. and Iran, with Vice President J.D. Vance leading the talks, and they could not reach a deal. So now the U.S. has to or is threatening to escalate as of now, as of 10 a.m. Eastern time. There is officially a counter blockade or a blockade in place. So basically, Iran, of course, has stopped shipping through the Straits of Hormuz. They have the ability to disrupt it, and now the White House and President Trump decided to counter that and basically not allow any ships going or leaving Iran from leaving. Now, until now, the U.S. has allowed that because it's sort of an escape valve for oil prices, right? It's a way. I mean, oil is fungible, so you allow some of it to come out, even if it goes to from Iran, if Iran benefits, but you keep the prices in check. But I think the White House, faced with this deadlock in the talks, decided to up the ante. And clearly, the way they decided to go about this is basically to cut Iran's revenue. Iran gets something like about 60, 70% of revenue, maybe more in wartime from energy. So if you cut that down, the idea is the US can gain some leverage over Tehran and force the Iranians at the negotiating table. Now, of course, what this means is Iran has threatened immediately to hit at the GCC countries, to potentially use its proxies in Yemen to close the Bab el-Mandeb, the strait that leads into the Red Sea and to the Suez Canal. In other words, they also have a number of ways in which can they ratchet pressure. So the question is, does this escalate? Does it stay kind of the same, or is this sort of the kind of maneuvering you see before more negotiations? And all three are still possible. Nothing has yet been decided. If you asked me before the weekend, and I wrote about this right before the weekend, I would have said the negotiations and the temporary ceasefire would have had about a 50-50 chance, which is a way of chickening out and saying, we don't really know. Now, when I look at it today, the reality is it looks much more likely that this will escalate again. A blockade itself has to be enforced. That means the US will stop Iranian ships. It will impact, obviously, the price of oil, which is sort of mean reverted to what was prior to the announcement of the ceasefire, is going in that direction, with markets obviously pricing this risk premium again in. And then, of course, if Iran retaliates, the US could restart again the air war it continued against Iran. The question is, how does it go from there? There are some less scary, some more scary scenario, but ultimately it seems to be on that pathway. I'd say probably 60-40 at escalation right now. But on the other hand, there is still a chance that you have this kind of, positioning and threatening, and then they come to a table. And I can explain why. My read on Iran, that although there is this media sort of, I would say, an analyst view about how they're fundamentally invincible and they're not going to budge, I see them much more amenable to a deal. They're actually under a lot of pressure.
Oh, really? That's interesting because you don't get that impression from them backing away. I mean, it seems like they have no choice but to give up their nuclear ambitions and adapt the enriched uranium, and to some degree, a new political power in place that would at least be amenable to working with the West to some degree. But let me ask you a different question. when you look at the Strait, so much is focused on the Strait, which the average American's worried about the price of gasoline and what the impact might be beyond gasoline. How do they still control the Strait? So if we're going to block their ships from going out, they can't make any money on their own oil. I get that. But then, is there really still some sort of ability from the Iranian military to launch drones, or how do they physically stop the Strait, shut the Strait down?
It's a great question. So, the reality is that it's not only the Iranian military abilities, which have been severely degraded. And again, if the war were to continue, or if they were to try to strike, at shipping again, they could get struck again. But the reality is, it's a mixture of the Iranian actions and at the same time, the sort of the risk aversion of insurers and shippers. I mean, the way to think about this is the same way the Houthis in Yemen closed the Bab el-Mandeb Strait until 2025 when Trump cut a deal with them after bombing them. But what they did, you don't have to hit every ship, right? You have to hit maybe even one out of 100, 200. At that point, the insurance and the shipping companies are not going to want to ship through it. Now, Iran's military, as I said, has been significantly, and military capabilities have been significantly degraded. Iran is not stronger now than before the war, and they have, as I said, they're starting to have internal fractures. They've kept the regime together, which is no mean achievement given the magnitude of the Israeli and US strikes, which is almost unprecedented. But at the same time, they don't have to hit every ship. They just have to keep the threat. And even if they have residual military capabilities, which they will have, you can't take every drone, every missile, every speedboat out, that would impair shipping through the Straits of Hormuz, and that's what's happening. That's why there's pain at the pump because ultimately you have about 20% of the world's crude and about the same amount of LNG coming from there. So that is again, I mean, some of it is being rerouted, especially crude with the Saudis and with the UAE, but a lot of it is not, right? So that is again the way they've been able to leverage this, which is otherwise I wouldn't say they're militarily strong, but this is sort of I would say control or quasi-control with Straits is giving them enough leverage to get them to this point where they're now, where they're negotiating with the US on terms that frankly they are maybe overplaying their hand, but they will probably, if they keep to it, get at least the ceasefire that resembles the status quo before the war.
Okay, so that's great. So then before I just to that question, you said something interesting that they seem to be running out of time. Like they have no choice but to come to the table. Why do you think that is?
Well, I mean, the trick about Iran is it's a repressive regime. It's not popular internally. Even with this war, I mean, you haven't seen the sort of rally around the flag effect you see in the war. I mean,
Sure, yeah.
they had massive repression and killing of their own protesters in January, which is one of the things that got Trump to, of course, to decide to strike Iran. It's a regime that depends on repression. It's a regime where the leadership has been wiped out. So in any regime that fits those two categories, plus misgovernance, corruption as a feature, not a bug, massive inflation, a banking crisis. So they have a hard time governing. They have to govern through repression. You have an elite that, as I said, half of it maybe at the very top has been wiped out. So you're starting to have this sort of intra-government and elites power struggle. So on top of that, their military repressive capabilities have been significantly degraded. And the longer they fight, if the war starts, they risk again losing that. That's how they keep control fundamentally because they're not popular. So if their military and repressive capabilities are degraded, if their economy is degraded, which it is, right? I mean, the US and Israel, right before the ceasefire struck, for instance, their aluminum plants, their steel facilities. So the regime has to think if they continue the war, what do they win? And if they win, even if they, let's say, keep control of the Straits of Hormuz, which ultimately I think they won't, at some point they will be left weakened after the war in a position where not only they infight, which we already see signs of that during negotiations, by the way, at least early signs of, intra-governmental disputes within the Iranian negotiating team. But ultimately, after the war, they're going to have to wonder, we're going to be weaker. Can we govern? Can we continue? And I think that's really what will drive eventually to negotiate is the fact that they want to maintain regime stability. And the longer the war goes, the less they will be stable after the war, even during the war. I mean, the idea that there will be regime change, which I think is hard to predict, maybe not likely, it's still there. It's possible that an ambitious general or faction of the Iranian government tries to coup the other. So they have to worry about that, and that's why I think ultimately they're amenable to negotiations, even if it would take more pressure on them to get to that point.
So then from an investment standpoint, the near term, I talked about the markets being flat. I would assume if oil goes to 120, that's when our base case that above 120 for a prolonged period of time, it's a very different, scenario. But what's your thoughts on near-term implications because of the conflict?
Well, we think that oil, I mean, it's already reaching 110 probably this week. I mean, it's not far this morning, last time I checked, right? I mean, it's reverting. And if you close the straits and if you have a few, as I said, there are more shoes to drop. I mean, there's the Houthis in the Red Sea, which again put pressure on markets, on especially Europe to Asia shipping, not only oil. So if you have these things, I mean, you could get to 120. The question is, do you get beyond that? And that's the critical question. I mean, our view and the view of our parent company, which is Oxford Economics, is that unless oil goes at 140 and stays there for a while, we're not going to have a recession. At least in the U.S. But if you have the closure of the Bab el-Mandeb Straits by the Houthis, if Iran starts striking critical infrastructure in the GCC countries. If the GCC countries enter the war, which they may, right, and they start striking Iran and striking, oil fields and gas fields there, at that point you could think of oil again reaching 140 or even 150, or in a case of panic, the reality is you don't know where oil goes, right?
Right.
I
Right.
mean, panic is panic. Um, does it stay there? That's the question. Because again, if it goes there for a week or two, it's manageable. I mean, it's a shock to markets, but again, it wouldn't result in a massively adverse economic impact. I mean, we have obviously some impact on inflation and so forth. But I think, that's the thing to watch. Can this continue for long? And does it take oil, let's say, well above 120 to 140 and keeps it there for a few months? That would be damaging.
Yeah.
Then we're in a different world. Then, I mean, then investors have to think about structural damage to the global economy, demand destruction, and what comes from that.
So what are some of the broader implications? We have other countries that are not participating, which is mind-boggling to me. So from the war beyond, sort of the geopolitics and we have U.S. U.S. politics, geopolitics, U.S. domestic policies, and then in terms of overall global markets, how do you see this affecting economics and markets globally, and why haven't other countries jumped in to help them? So still so very surprised at that.
Right. I mean, a lot of countries have I mean, if you look at our European allies, America's European allies, I mean, they were not on board with this attack. They question whether it was the right decision. I mean, a lot of them have held back. They've cut U.S. Ability to use military bases or air rights, even in Europe, NATO, which just causing massive stresses with NATO. I think NATO survives, by the way, but obviously in a very stressed and potentially, I mean, for the first time ever, there is the possibility that it doesn't. So it's not the risk is not zero, but I think overwhelming cases that it does, but this causes additional stress within NATO. Again, you've seen that if you remember in 2003 when the US invaded Iraq, and again, the Europeans were not all on board. I mean, that's the same thing with US's Asia allies. Like if you think about Japan or South Korea, they're not particularly keen on getting in this conflict. And of course, Iran has its own supporters, Russia primarily, also China, which again, although China has to hedge its bets because it also has an economic relationship, of course, with the GCC countries, and it's interested in having the access to energy from the region. So it's a complicated geopolitical situation. The U.S. action again was not particularly popular, and even in the U.S., of course, I'd say half the country is opposed to the war, half is probably in favor. So it's a split situation. The longer the war goes, by the way, and this is true about every U.S. conflict, the support will probably diminish if the U.S. does not win quickly. And that's, of course, a constraint on the Trump administration, why it wants a settlement quicker, not to speak of the market damage. Now, in terms of the other thing in the U.S., my view is that, our view is that within, probably, if not now, even if the war escalates, for the reasons I mentioned, and the Iranian side having an incentive ultimately to cut a deal, that we're going to get maybe another month or two of conflict. I mean, that could be quite sharp. You could have panic, but ultimately this gets settled, and it's not like the Ukraine war, which lasts 4 years. It's not going to last 6 months. So I think that's still the bet. And if you look at that from a markets U.S. perspective, that's actually bullish growth because you have a Trump administration that wants to boost growth and incomes before the midterms. So, they're doing whatever they can on fiscal, the OBBA is kicking in, you have deregulation. So, and on the other hand, if this conflict is settled at some point, that would be that would be reasonably bullish for U.S. assets and especially equities. So we think that again, you may have this short-term volatility, you may have another drop in the market, you could have an episode of panic, but ultimately, we remain and Alpine remains quite bullish on the U.S. this year.
Do you think this affects the midterm elections? I mean, right now the talk is a blue wave that's going to be exorbitant. The what happened in Wisconsin, for example, with Dakota judge, and the election in Georgia, where the seat went Republican, but on less than expected. To me, this is a knee-jerk reaction to what's happening now. But we're still got months away before the midterms. But what do you think? How long does this psyche last on people?
Oh, that's such a good question. First of all, I mean, I'd preface it with what you said. I've been covering U.S. elections for 20 years, and you know, yeah, whatever now, we're in April, we're, 7 months, give or take, from the midterms, right? That's an eternity. Anything can
Yeah,
happen, right? I mean, the
yeah.
reality is that US elections, you can't fully predict them in advance. But, if you were to put a gun on my head and say, okay, Dan, make a prediction, my view would be, Democrats are favored. And even without, let's leave this war aside, right? But I mean, you think of an environment where, it's a midterm election with an incumbent president, usually the opposition party gains seats. So Democrats have a structural advantage. They have won most of the off-year elections last year and this year, right? I mean, if you think about most seats flipped, I think most of them are Democrats, whether it's, local, you can think Pennsylvania, you can think other states that are sort of purple states. The Democrats have done quite well. Now, is that because their Democrats are popular? Not necessarily. They actually are not. Democrats have lower favorability ratings than Republicans or Trump, but it's also off election year. So it's not only popularity, but it's also who turns out to vote. The voter turnout, and usually in every US election, the angrier party, which is usually opposition party, shows up in force.
For
So
sure.
that should favor Democrats. So, if you put a gun in my head, I say, well, I mean, Democrats are favored. If you look at, congressional polling, they're doing better. But again, the Republicans are down but not out. The fact that Trump remains seem more favorable than Democrats, and so the Republicans, if he manages to turn, especially the economy around and end this conflict, I mean, Republicans will have a fighting chance. I still think they will be the underdogs in November. But at that point, you're not looking at a blue wave. You're potentially looking at Democrats maybe taking the House, the Republicans maybe keeping the Senate. So again, you have this intermediate stuff. Now, of course, if you have a long war, if you have a economic downturn, if you have a markets downturn that hits
That's a different narrative.
people's 401(k), that's a different world.
Yeah. So then we have switching gears for a minute. Much to my surprise, China has been quiet on much more than I would expect. I thought they would have been much more interested in this simply because how much oil they get from that region. But Xi and Trump are due to meet here. And is there a rivalry between the two, or are they going to work together? What do you think the end result? What's worth watching on if the meeting happens, by the way?
Absolutely. So, I mean, the US-China, I think of it two ways. One of it is like the short-term risks over the next year or two, which, I'll talk about in a second. But the other thing, it's really what drives global geopolitics, the rivalry between a superpower, which the United States still is, and a rising potential superpower, which is China. And I think that's going to be around long after we're all retired. I mean, think about, this is not a Cold War. I mean, the US and China trade, they have a much less antagonistic relationship than the Soviet Union had with the United States. But at the same time, it is the defining rivalry, globally speaking. I think that will persist. Now, the question is, how do you manage that shorter term? And of course, we've had the trade conflicts and we've had tensions, there are fears over Taiwan. But ultimately, I mean, it seems that both Trump and President Xi in China have an incentive to put some sort of floor under it. I mean, even if you look at the Iran situation, Iran is, of course, has a quite close relationship with Beijing. Uh, China hasn't been fully supportive because, again, it wants to maintain a relationship with other GCC countries, which are opposed to Iran. And because, again, it seems that there is this push for a detente where both US and China sort of, even if you lower the tensions and you lower the amount of trade or restrict it to non sort of high competitive strategic areas like advanced tech or manufacturing, it seems that that's what Trump is trying to do with Xi. So, the critical thing to watch short term, and that's next month, is whether the two meet, right? And if you have this meeting, you're probably going to have some goodwill coming of that. My view is that this détente holds for a year or two. It's both in the interest of China and the US not to really rock the boat for domestic economic and political reasons. If you look at Beijing, if you look at Washington, I think those interests match. Of course, there are wild cards. I mean, Iran less so, but if you think any kind of spats in terms of trade, like the rare earth stuff, which could have been a deal breaker last year and was sort of fixed, at least patched. There's always the fear of a Chinese mainland invasion of Taiwan. I think
Right.
that's unlikely. I don't think China's that risk accepting. Trump is quite he's not quite risk averse, as we've seen with Venezuela and Iran. On top of that, any kind of war between mainland China and Taiwan could bring the United States in. At that point, you're looking at great powers that are nuclear armed fighting each other. So I think nuclear deterrence, like in the Cold War with the Soviets and the US, will keep the peace. It will be tenuous, it will be tense. There are a lot of interesting investment implications for that because if that's how you define the world, you think the world will be defined by this great superpower rivalry, and they're really the two, one, declining maybe, but still superpower, which is the US, and one China, which is rising. Other countries, of course, matter, but if you think of the world this way, I mean, increasingly you're going to have this decoupling. You're going to have, and there are interesting investment implications that come from there in terms of reindustrialization, demand for commodities, because
Yeah.
both US and China are looking to build separate supply chains, separate factories that are secure from a national security perspective. They're looking to compete, and that's duplicative, right? So that's interesting both from a Western industrialization perspective for certain commodities. Generally speaking, we're favorable of anything related to that energy, hard assets for those reasons.
Yeah, they have too much to gain by staying together. I would say one thing that has me a bit spooked is you're watching sort of countries trying to take over seas. I know certainly China's trying to do that with the seas around them. Obviously, the Strait of Hormuz. I don't know what you thought about this trend of free seas, which the world has been accustomed to forever, maybe ending. And to me, that's going to, at its core, maybe there's some discussion around that. So we don't see that happening. But I don't know what your thoughts are on that. That has me a little worried about global growth at a time when we need their commodities, they need our stuff, and a global super cycle in commodities, which we think we're about to enter, the world needing more power and so on. You don't want to have an ocean issue where we can't move stuff around.
It's a tricky issue. I mean, the Iran, if Iran were to take control and nationalize the Straits of Hormuz, right, which of course they're trying to, that would be a bad signpost as that goes. It'd also be a signpost that U.S. naval power, which really is what's ensured free seas since the end of World War II,
Yeah.
is not effective anymore, and that could have deeper implication. I'm not in the U.S. declinist camp. I don't think this will, destroy the dominance of the dollar or even the petrodollar, but it would be a step in that direction. It would be a negative step. Now, of course, China has the claims to the South China Sea, the so-called nine dash line. They have, a number of issues with neighbors, even Japan and the East China Sea. So, are you going to see a proliferation of these things? The U.S., I mean, you can think about even the United States trying to re-exert control of the Panama Canal. Last year with Trump again making a decided push. So again, if you start to see this kind of closure, that would have an impact. It's at some point that would, even if there are not tolls being charged, that would either reroute shipping or more. I mean, the other way to think about this is like, okay, what do you do if shipping is no longer secure, or if shipping is dependent on geopolitical alliances? You're going to have to rebuild your supply chains. The simplest example of that is the fact that the Saudis and the UAE now are thinking of building more pipelines that go west, whether into the Mediterranean or even the Red Sea, in order to avoid the potential for Iran having this kind of leverage. So that can have also very interesting investment implications, but it would re-scramble this idea of free shipping lanes and being able to produce, let's say, if you're a US company, being able to produce things in places like Vietnam or Thailand, which would be again in a more geopolitically risky area. So you could think at that point, okay, the US is going to, in terms of, labor intensive manufacturing, a lot of that is not going to go to Southeast Asia for the US, maybe for China will, but it will go to Latin America because it'll be more secure.
All right. And that makes sense. That in the end, you have to have those shipping lanes open, but otherwise we'll pivot to somewhere else. We have the money and the power to do it, and that may be the case. So base case sounds like you're not overly concerned about the current state of the war. This may be a potential resolution coming, or maybe not the end of not significant escalation. That you're still bullish on U.S. equities. I think fairly bullish on global economics, but maybe let you sum up where we're at from an investment theme standpoint over the next, call it 1 to 3 years.
Sure. So, yeah, I think that's fair. I think that this war could escalate. You could have a moment of panic. I don't think it's going to last for 3 4 months. I hope I'm right, of course. Wars, I would say that take that with a grain of salt because wars are unpredictable. I mean, if you remember with the Ukraine war, people were predicting was going to last a week or two, and well, it's still being fought. It's
Yeah.
not the same kind of war, so that doesn't mean I'm wrong, but it's something to always keep in mind that wars are hard to predict. They're unpredictable. It's a complex adaptive system in the sense that both parties fight based on what they have. It can last longer. But I think the logic for calling this again, you could have another bout of escalation for a month or two, and then it ends with some sort of negotiation with the straits potentially open or having some compromise. I think that's a still a good workable assumption. Now, longer term, and that's as you said, that's positive for most assets. I mean, one good hedge that we think is interesting for that, and it makes sense, is also the fact that going long bond duration in the United States is interesting, especially if we're wrong, and for instance, you have a economic damage being done at that point, that becomes, a safe haven asset, of course, in treasuries, longer duration treasuries. But I mean, if you think longer term, I say there are three main themes that I think are interesting. And of course, AI is an overlay cuts across, but I would say the first one is reindustrialization in the West, especially in the United States, is going to work partially because we cannot really bring back industries that are labor intensive, so capital intensive industries. So high tech, advanced manufacturing. I'm very bullish robots because frankly, if you want to have advanced manufacturing in a country with expensive labor, that's kind of a no-brainer. It plays into the AI story. Of course, semiconductors and all these things, which, they may or may not be expensive depending on where you're looking at them. Aerospace and defense, I think the world is rearming, although I don't think there was going to be a conflict over Taiwan. I think that we're in a more tense geopolitical world. It's not only the United States, it's Europe, it's Asia that are rearming. So I think aerospace and defense, which is expensive at the moment, but has geopolitical tailwinds. If you look at energy, well, I mean, everybody can talk about oil. I mean, you could make an argument for Henry Hub because again, the US will export more LNG, especially if the Middle East stays impaired, if Qatar has taken damage during the war, which it has. But I mean, I'm also bullish things like nuclear, which is a stable form of power. I'm bullish increasingly alternatives to some extent. I mean, you could say they're interest rate sensitive. They had a lot of political headwinds, but a lot of this have come off. A lot of subsidies, even in Europe, have come off. And lastly, power grids, which are kind of a no-brainer. It's the perfect political play. We're building AI, we're industrializing in the West, even in emerging markets, you need secure power. In order to be a great power, you need cheap power, frankly. So it doesn't matter if you're a government in, let's say, Europe or the United States, you're far left, far right, anything in between. Everybody's on board with having secure power transmission. So that's an interesting sort of geopolitically motivated play that has a lot of domestic political support. And the commodity side, we're bullish, as you said, commodities overall. I think we're entering a new cycle that is partly driven by this sort of reindustrialization and rearmament AI, the drive for commodities and securing supply chains. And within that, industrial metals, copper, aluminum, which again are critical for rearmament, for reindustrialization, for AI again. And also the other sort of a subplay that I think is interesting is ex-China rare earths. So, the United States and Europe and Japan do not want China to have this massive leverage because they produce and primarily refine most of the rare earths there are, which are critical for pretty much every industry from high tech to aerospace and defense. So I think increasingly you're going to see a push, and you are seeing this is starting, I think is going to accelerate for that is subsidized, that is supported by the US government to having refiners and miners of rare earths outside China. So, longer term, you can think, that's a bullish case. I think the US wants to be independent of China of rare earths in somewhere, give or take 2 to 5 years. I think it's achievable, but requires this sort of massive government effort. We're starting to see it. So again, from an investment perspective, I think that's kind of follow where the governments are putting their onus and their strategic sort of center of gravity. And part of that is having, rare earths that are not controlled by Beijing.
Yeah, for sure. We find that same theme fascinating because the idea of a commodity exposure or natural resource exposure, not only it's the rebuild of more demand for power. Just this weekend, a great piece I read about how data centers are really taking more out of the power grid than anyone anticipated, and maybe worse than expected. So that's going to make for the summer really difficult. Well, you're going to need new power, and I agree with you on the uranium front. to me are I'm sorry, yeah, uranium, the power, nuclear power plants. I've done some reading on modular nuclear reactors and how fascinating they are. So we really think there's something there. Really quite cool. Well, let's wrap up with this. First of all, this has been great. I think we covered so much ground. I hope everybody was able to listen in. I guess in the sum total, if there was something you saw in the headline, well, let me ask you a different question. If we don't get regime change and we don't get, anything outside of a reopened strait, is it a victory for the United? How did the United States define victory here?
The terms vary from day to day. I mean, in the beginning, if you remember, Trump wanted the regime change. Then the question was like, well, we need to destroy Iran's nuclear and missile capabilities. I still think it's somewhere in between. The reality is that the terms of what constitutes a victory change. I mean, for Iran, it's very simple to define them as survive in power, which to some extent they've already achieved. Now they're making maximalist demands. They want to keep the straits. I think Iran controlling the straits, and that's a there could be different variations on that. It doesn't mean they may have some control, nominal control, just sort of a sop for face-saving reasons that the U.S. could negotiate. But again, if they have meaningful control of the straits, that's definitely a strategic U.S. defeat. I mean, one way to think about this war was a war that the United States started, so you could say it was a war of choice. If you ended by letting the Iranian hardliner regime, with a hard aligned, by the way, leadership in power and with control of the straits, that's not a victory. And that would have signals and would signal to other countries and US rivals, whether China, whether Russia, that the US is potentially weak, and that could have some negative geopolitical implication, could create instability elsewhere. I don't think that's the end. I don't think, obviously, I don't think that's acceptable to the Trump administration. The question is, the administration has to balance domestic constraints and market performance and the looming midterms and frankly domestic support vis-a-vis the ability to withstand this war. So ultimately, it's a battle of wills between can Iran sustain itself fighting and opposing the U.S. Longer than the Trump administration can. I think the jury is still out. As I said, I'm more optimistic that the U.S. cannot. I think the Iranians have to some extent overplay their hand by making maximalist demands. And that in many ways paints the Trump administration a corner, which will get them again to potentially, as we've seen this weekend, to escalate, to put a blockade in place, which is really a cheap way of interfering with Iran's revenue. I mean, the other idea would have been to occupy strategic islands like Karg Island, which is Iran's main oil terminal, or the strong points, that the islets at the mouth of the Straits of Hormuz. That's militarily more risky and costly. So this is a way of doing that, maybe on the cheap as a first step. But again, if this continues, we could see further escalation. I think ultimately our guess from the beginning, the best we can estimate is that the war probably ends on a draw. Very much like the war last year, the 12-day war, which ended with everybody sort of going home and calling victory. I think the straits will reopen at some point. I don't think Iran maintains control. But again, the margin of error here is huge because it depends on these sort of complex calculations on both sides. And the question is, to what extent can the Trump administration sustain the pressure on Iran? And that's still quite an open question.
In the weeks to come, we'll figure that out. This has been great, Dan. Thank you. I'm sure the listeners really enjoyed your point of view. And obviously, when it comes to Alpine Macro and our relationship, we rely on you all very heavily for many of our investment themes and how we go about managing money and helping folks out. So thank you so much for joining me today. Really appreciate it.
Thank you, Philip. Thank you so much for having me.
Well, we got a fun last segment here, buddy. So I have my shout out of the week. It's always fun. I always like to wrap it up with something positive. Not only are we getting to the longest day of the year, one of my favorite holidays is we're not far away. I was outside last night. It's 7:45, and I was fixing my natural gas, whatever, propane tank heater, those tall tower heaters. I took it apart, found the issue, excuse me, and put it back together. So I was very proud of myself. But 7:30 at night, it was still sunny out, so it was still bright, it's still light out. So I've always enjoyed the springtime. As where I live, everything is coming to life. You drive around Nutley, New Jersey, and it's spring everywhere. Flowers are booming. The cherry blossom trees are in full bloom right now. Really quite beautiful to see. So it's a pretty time to be outside. And reminds me of the Masters tournament. And not a huge golfer. As I get older, I'm trying to play a little bit more. I'd like to break 100 someday. I'm a terrible golfer. I got this job of mine that keeps me pretty busy, which I love. Don't get me wrong. So my shout out of the week would be to Rory McIlroy. I mean, when you see somebody do something pretty amazing, winning back-to-back Masters championships. I was pulling for Scotty Scheffler. I think Scotty's a great player and fun to watch, great father. But certainly, McIlroy, to his credit, didn't buckle, and he led almost the whole tournament. Fell behind 1 point and again rallied back. So my shout out, and that doesn't have to be sports. I do sports probably way too much, but this week is Rory McIlroy. Anybody out there in the world, Dan, that you'd like to give a nod to?
Not top of my head. I like yours though very much. It's a
Okay.
good one. So
We'll
yeah.
share that one. Well, Dan, thank you very much for joining me today. Everybody, I hope you have a wonderful week and hope your weekend was fun. Hopefully, we get through this war and we get some resolution here. My number one theme of the week is listen, don't panic. That starts. Two, I can rely on people like Dan to help us get through this from an investment standpoint. And I'll leave you with a third one. You notice neither one of us was both bearish. I mean, bearish only happens if we really get really high oil for a while, and that doesn't seem to be the case. So in that sense, stay invested. Look for opportunities to buy good stocks on sale, and I'm sure in the long run we'll be happy we took advantage of this opportunity. Thank you, everybody. Take care. Have a great week.
Thank you.